Welcome to the Tax Lien and Deed training series brought to you by Tax Lien Investor Secrets. I'm Shade Foray, president and founder of Tax Sale Solutions. We provide educational training content and curriculum for tax lien investors and students across the country. This training series is designed to teach students how to invest in tax liens using the internet. This first session will be dedicated to tax lien basics and helping you understand the fundamental concepts that are necessary to move forward to more advanced concepts with tax lien and deed investing. Obviously, the most common question that we get is, what is a tax lien? The best way to answer that question is to understand how the county government works with property taxes. Anyone that lives within county boundaries and that owns property is required to pay an annual property tax. Now, that property tax plays an important role for the county. It goes to provide services that many of us take for granted. Services such as education, police and fire departments, road construction and maintenance, and the county services themselves. Tax liens are also known as ad valorem taxes. So if you are going through county records and you happen to see something that says ad valorem, you should recognize that that is a property tax that they're talking about. The actual property tax rate that you pay in your particular county is based on a combination of a few different things, and I think it's important for you to know how they come up with that rate. The county is going to set, every year they'll set a budget based on the amount of money that they believe they're going to need for the following year. Next, they'll have the county assessor value every piece of property within county boundaries. Now, once that county assessor has an assessment, they're going to add up the total amount of value for all of the property within the county. Then they're going to compare that to the budget that they believe they'll need for the following year. Now, based on those two numbers, they're going to come up with a percentage rate that they'll need to multiply that property value number by in order to reach their county budget expectations. So with most counties, you'll find that your annual property tax rate can vary between 0.5% to 2 to 2.5%, depending on how much your county spends on an annual basis. So what happens if the property owner here, in this example, it's property owner Bob, doesn't pay his property taxes on time or doesn't pay his property taxes at all? The county needs some way to enforce this because obviously there are a number of services out there that are counting on it. Services such as education, police and fire departments, road construction, these are all services that are provided on a continual basis and that require consistent funding. In fact, some counties will spend as much as 60% of their annual revenue on educational expenses alone. So the county needs some type of an enforcement system in place to make sure that they have a way of collecting delinquent property taxes. So if Bob doesn't pay his property taxes within a set time period, the county is going to issue a tax lien against his property. Now, the reason they're going to create this tax lien is because it gives them an opportunity to make the money that they're missing right now from the property owner not paying his property taxes. The way they do this is they hold an annual sale where they invite the public and any investors that might be interested in purchasing tax liens. Now, the reason why an investor might be interested in purchasing tax liens is because the tax lien that they purchase has a guaranteed rate of return. So it is a rate of return such as 18% in this example. Most counties or states have a rate of return that ranges between about 10% on up to about 25% or higher. So that's an excellent return here for the investor, but let's talk about the security of that investment. There is a redemption period attached with every tax lien that's purchased. That redemption period depends on the state you're working in and can range anywhere from 6 months on up to about 4 years. Now, what this redemption period is it's the period of time in which the property owner has to repay or to pay that delinquent property tax amount before the investor can take some type of legal action to ensure that he makes his money back. A lien, by definition, is a claim against an item which affects the ability to transfer ownership by another party, which utilizes that item for security for repayment of a loan or other claim. The easiest way to understand a lien is to look at liens we see about us every day, things like a mortgage or an automobile loan. In both of those cases, the mortgage company holds the deed to the property. The lender for the automobile holds the title to the vehicle, and they do this as security for the money that they're lending out. They do this to add additional security because if the individual that's taken this loan out for the money, if they do not actually own the physical property, then it gives the right to the lender to foreclose on that property or to repossess it if necessary to recoup their loss. So let's see how exactly this situation works. Investor Jack, in this example, shows up at a county sale and purchases a tax lien from the county. Now this particular county pays an 18% overall rate of return, and there's a 2-year redemption period. At this point, the property owner has 2 years from the date of the sale before the investor can initiate or begin to exercise his foreclosure rights. That lien, because it's been placed against that property, actually has the power and the ability to give the holder of the lien foreclosure rights. So it's just like any other loan. If Bob does not comply with the 2-year redemption period and doesn't pay that back in time, he could actually lose the property as a result of it. Now, to remove this lien, the property owner is required to pay all of the delinquent taxes, including any penalties or fees that are attached with that. One thing that is certain in this country is if you are late paying any kind of a tax, there's going to be some kind of a penalty or a fee that you're going to pay on top of what you already owed. In this case, that penalty or fee actually ends up going to pay the investor that gave the county the money to purchase the tax lien. So let's say in this scenario that the property owner pays back the delinquent amount along with any penalties or fees that are associated with it, and he does this to remove the lien. Well, at that point, the county will cut a check to the investor for his initial investment plus the rate of return that he was guaranteed when he purchased the loan. Most counties will cut these checks within about 5 to 10 business days. Now, what happens if the property owner doesn't pay back the delinquent amount within the 2-year redemption period? Well, the investor still has a number of options here to make sure that he makes his money back. The tax lien that this investor's purchased gives him the right to foreclose on this property if the property owner does not pay back that delinquent amount before the 2-year redemption period expires. So the investor can actually own this property outright just for paying the delinquent property taxes for a single year. We'll get more into foreclosure and exactly how that situation works, but it is important to know that it does hold foreclosure rights, although a tax lien itself doesn't have any property rights before that redemption period is up. So there really are only 2 outcomes here in this situation. The investor is either going to receive a high rate of return for purchasing the tax lien, or the investor is going to receive the actual property as a way to pay back his initial investment for the delinquent property taxes. Tax liens are one of the few investments out there that actually really do create a win-win-win situation for everyone that's involved. The property owner is given a grace period to repay his delinquent property taxes, which in times past, if you think about the European countries that many of the forefathers that settled this country came from, if you were delinquent in paying any kind of a tax there was a good chance that you would lose the property altogether and you'd probably be incarcerated. So a 2-year grace period is a great step up from what they were used to. Now, the county receives the delinquent taxes that they need, which allows them to continue to provide these necessary services. So that's what's most important to the county. and the investor is able to receive a high rate of return or the actual property for investing in a tax lien, which is an incredibly secure investment.